You're listening to Breakaway Wealth, the show designed to help you build wealth faster, think bigger, and break out of the herd. Now, here's your host, Jim Oliver. Before we jump into today's show, we have some exciting news to share with you. Our brand new online community platform is now live. Get access to free on-demand, in-depth training courses on topics like infinite banking, cryptocurrency, real estate investing, and much more. Just go to community.createtailwind.com. That's community.createtailwind.com, or check out the show notes of this episode to find the direct link to request to join the community. Now, on to the show.
Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, my guest, Charles Carillo. Charles, welcome to the show.
Thanks so much for having me on today, Jim.
Absolutely. Charles, I always like to talk about real estate, especially right now when all these people are out there saying, oh, interest rates are too high. You're in Southwest Florida. Insurance rates are too high. You know, it's got all these unknowns. I love when people just give up. But before we dive into that, tell me a little bit about you. Tell me your background, how you got to where you're at today.
Yeah, so a short background on myself, I guess. I was born into a real estate investing family. My dad's been a multifamily investor since 1984. And so I grew up in the business when I was younger he self-managed, and him and his partner at one point had like 100 units at one point before they started selling them off in like the late 90s, early 2000s. And they were really mostly D-class properties. So they were very management intensive. He never had third-party management. And so that was a whole second education, dealing with him and dealing with everything that he went through and watching it. And after I got out of college in 2006, I bought my first property, which is what we call now a house hack, but back then it was or what it still is I bought a 3-family property and lived in one of them, rented out the other 2. And it covered the majority of my mortgage, and that was pretty great. And then I did it again at the end of 2008, which was a whole different climate. And then I went to make the foray into commercial real estate at the end of 2009 with a small 5-unit property, and been doing that all since. And since getting down to Florida in 2012, because that was all in a small town in Connecticut, we've really been focusing on buying larger apartment buildings and been involved with syndication since 2018.
That's awesome. You know what I really love about your background is that your family taught you how to do it a little bit, right? They said, "Hey, it's okay," it makes me think of actually an ex sister-in-law and brother-in-law of mine. But when we were, I grew up really poor. I thought I had to go to college, get a job, get in Wall Street. That's how I was going to break out of poverty. And here was this guy that he said, no, my family, we own motels, real estate. We own this other stuff. I don't want to go to college. I don't even like school. And I was like, no, man, that guy's, what's he thinking? And then I wasted 15 years of my life trying to do it the mainstream in the herd way, while he was just being free and buying other businesses and just doing what he wanted to do and not worrying about school, educating himself, but not worrying about school. So talk about how you made that progression of education, because, I hated school, but I loved to learn. So, and I don't think those two things go hand in hand. Sorry, public school teachers. But for me, it didn't. Talk about how you progress, because there's a lot of people in the audience, Charles, they're thinking, okay, you started small, I get that, but then how do you progress with your education, your confidence, all of that?
Yeah, so when I was in college, I wouldn't have bought that property so soon after college if it wasn't for my dad really kind of nudging me in that direction. And my parents are, I guess they have more education than my brother and I. My brother and I went to 4-year college, and my parents have master's degrees. But it was different is that it wasn't a huge theme in our house to go into really upper. It was really, I've been an entrepreneur for so many years since being back in high school. I never had a real W-2 outside of college or during college. And, we just grew up with, my dad always had a business or businesses, and he always had different investments and stuff. And So it was something that I kind of learned about, and that was what I was doing, and what I really want to focus on. And then put money into real estate was always like the end game for everything. You know what I mean? And I think when we started with small properties, it's just there's not that much that can go wrong. There's stuff that can go wrong, but it's not like you're dealing with you're dealing with other people's money or anything like that. It's all your money. You make mistakes. It's you know what I mean. It's much easier to bear than if you're taking money from other people. So when after so many years, people would ask me about investing in real estate with them, friends, business partners from other stuff I was doing, and then it was you really like, well, how the heck do I do this where I'm bringing on other people? And that was where we like got involved with syndications, and people now could invest alongside us in what we're doing. And those properties, because you looked at all the pros and the cons of larger properties and all these hassles I was dealing with on a smaller level, they weren't. So, when I was speaking to a mentor, they were just telling me the only way you're going to be able to like break through to larger properties and to be able to scale is when you're getting into, not the only one of the easiest ways of doing it would be getting into larger properties. And now when you look at the number of units and how easy it is to manage it, I mean, I spend less time on management on large properties, 100 plus units, because you have on-site management there. So like overseeing asset management versus when I had, a dozen or so units myself that were, even though they're on the same block and I had the same management company for them, it's a lot more intensive, no matter how good your manager is, and you still have to make those decisions on a high level. So that's what it was, kind of a necessity of kind of moving forward to larger properties and bigger buildings.
No, I love that. One thing that, and you said a lot right there, but the thing that kind of unpacked to me is I want to talk about like your underwriting process and kind of what you learned along the way. Everybody has a little bit different due diligence, but it's always interesting to see, because I think when you're looking, and there's a lot of people in the audience that say, hey, I'm running my business, investing in what I know, but I need opportunities to partner with companies, partner with people that know what they're doing. Dan Sullivan wrote a great book called Who Not How. So it's who you collaborate with, not learning how to do it. Now, by the way, you could collaborate with somebody passively and then figure out that you want to do it more actively as you build. But that transition, I think, is sometimes what scares people. So, talk about what you've learned in that process, and kind of what's your guys' niche? Like, what's your niche, Charles? Like, in how do you underwrite it to know that, hey, we got a really good chance of this being a great property and a great investment for not only our investors, but also ourselves?
Yeah, that's a great question. So I would say when our niche, what do I say, is our buy box for real estate is really, we're buying properties built 1985 or after. It's 1978 or after, but really we're going mid 80s all the way really to like say 2005. There's not really a date of how new we can go on it. We're looking to buy in B-class areas and properties that when you're buying in the 80s and newer, you're avoiding a lot of issues. And because people are always like, why is it like, why is this cutoff like right around there? And the cutoff really is like in the late 70s, because when you get into the 80s, you don't have to deal with really asbestos. You don't have to deal with really lead. You don't have lead paint. You don't have to deal with all these different aluminum wiring or all these different things that were really shapeshift type construction that was done years before, and you kind of push by that. So it means that you don't have to do major renovations on the property. Really, the bones don't have to be really changed when you're getting into these properties in this newer age realm. And then in areas, I mean, a lot of the due diligence is done just by, you can do a lot of due diligence on a property by just seeing the market, number one, as like the MSA metro, and then it's really getting down to the neighborhood without even seeing the property. And you have an idea of exactly what the class of that property is. You can drive around and see properties and how many cars are there during the day and how quiet it is at night. And, all these different things you can pull. There's many different websites for free. You can find out exactly what the income levels are, so you know exactly where those lines are in a new market. So exactly where, hey, over here is where they make this much, and then it changes on this street. This is where they make this much. And then you can kind of see these. And sometimes they're invisible and sometimes they're not, but usually you have to be there physically because you might not see a train track or you might not see that double road that goes across that really changes the neighborhoods. But your tenants are going to see that. So it's important that a lot of the due diligence is done at that level. And when we're buying properties at B-class property, we found that to be a very resilient, and especially where we are now, which is kind of an unknown area. interest rates going up. People tell me there's going to be a recession. People tell me it's already done. We're in a new bull market, whatever it is. So really, it's if you're buying properties like that, you're able to set up a debt structure on them that's going to allow you to go out 5 or 7 years with them. That really insulates you from a lot of issues, and especially if we're in a growing market, which is where we are down in the Southeast. We have a number of markets that we focus on. But with those things checked off, that really eliminates a lot of potential issues.
Yeah, I again, I like a lot of what you just said because, it's I have a friend who is in Wisconsin, and he has all of his properties within 75 miles of Appleton, Wisconsin. And he has a niche and he has a system, and that's his market, right? And I think he figures that he's got enough in that market that's he doesn't need anything else. And it's cool. When I look at being here in Southwest Florida, and I look from here, say up to where my scope goes, like say to Louisville, there's so many markets that I think are amazing between here and there. And not only for real estate, but for businesses, for everything else. But, when you're investing in real estate, you're in the real estate business. We have to think of it like a business. And so when you are a passive investor, you're investing in a business, you're investing in a company. And, what do you see that, like, when people are holding back, they're not taking action and building that real estate portfolio, what's the number one thing you see, Charles, that holds people back?
I think when there's any type of uncertainty, and we've seen this, and I mean, a lot of companies that do similar to us with working with passive investors see this as well. And raising money in 2021 was much different than it is today, and especially at the end of 2022. And you have people that just, when anything kind of out of the norm happens, they just sidelines, money in a money market account. And I understand in certain situations, but in other situations, I made that mistake too in the beginning of the 2010s, where everything was up dramatically from what happened in 2009. And you're like, wow, this is, what's going on here? And at that point, I wish I was already buying as well. And I came back and started buying again, but it's something I'm not making that mistake this time. I would consider myself a buyer and reviewing properties. And, there's not that many deals out there, so it makes it much easier now. And you can work at other parts of your business and working on projects and properties you already have, and kind of like we're spending more time getting those to where they want even faster. But I think you just see with a lot of investors that whenever there's like a little bit of hiccup, same thing with like 2020, you know what I mean? People just like pull back. And I understand that's an unknown. You don't know what's going on. But we just sold a property that we bought in the summer of 2020, and it was a fantastic return, one of the best ones we've done. And it was just because you didn't have to get rid of all the buyers. There were still buyers out there, but there were sellers out there, and there weren't as many buyers. So if you see that and you're like, okay, people aren't moving from Tampa, this is where the property was. People are, and then we had no idea it was going to be so dramatic what happened. But it was one of those things that I think if you're always looking at property, and this is like the mistake I see with a lot of investors, because you're like, hey, like, that saying, blood in the streets, that's when you buy kind of thing. People don't do that. You know what I mean? That's why it's one of those things you read in a book. I think the majority of people are waiting for it to go, they're waiting to see, already go up, then they want to ride on it and they sell at the wrong time. And that's how the majority of people do it. So if you buy real estate, you're keeping it for longer term. You don't have to time the market. It's really just you're buying good properties that are already cash flowing, and you can come in there and you're able to do work to the property. You have this business plan, you're going to be there for 5 or 7 years. If you get it priced better earlier on, fantastic, you can sell. But it's something that I think people always have to be looking at. If they're interested in real estate, they always have to be reviewing properties and seeing where the market is.
Yeah, no, I like that too. That greed fear cycle is in real estate just the same as it is in Wall Street. Yeah. And I remember when I was when I did full service financial planning, I remember this person came to me and they said, Jim, I want Janus 20, and I'm like, well, it's up like 35%. Like, okay, you don't want it now. And oh yeah. And then I've got this other, and all of the Janus funds were in the same investments. And so it was like, no, you don't want to do that. I had them sign a hold harmless, everything else.
Yeah.
And what happened? They got in. What happened? It went down. They sold, and then they still fired me because even though I told them not to do it, right? And so it's funny because don't get out if you're going to get in with those kinds of, in Wall Street, you can get hurt because, you don't know where that company is going. In real estate, it's different. But the thing that I think that people need to understand better, Charles, is that all of the advantages of real estate, and whether it's, to me, one of the biggest things is if I had $1 in 2020, it's worth less than 70 cents today because of inflation, right? And we can talk about where we're going with inflation and deflation and all that stuff. But ultimately, the dollars in my pocket today are worth more than they are going to be in the future. So that means why would I want to save money? Because it's going to be worth less when I want it or need it, right? So why would I put money in like a 401k or something like that? Assets, when there's inflation, what do? What happens to their value? It goes up, right? So also your tenants' rents go up, right? All of that happens. So do you ever have people that are hesitant to take money out of Wall Street or in instruments and put it in assets? And maybe they don't even understand depreciation or anything else. I don't know how that all works in your guys' system, but maybe just talk about that for a minute.
Yes, we've had investors that, most investors they're having that we've worked with, they have some level of real estate already, whether it's maybe another passive investment, or usually it's like I have a duplex or something like this, or another single family house rental, or that they did and then they realize, well, I can't scale this, I don't have time, I'm running another business, or I'm busy professional. And I think I've never really told people, hey, I've never pushed people it's to move money or anything like this. You make your own decisions. But the thing is, when we're getting into real estate and how this kind of changed over the last couple of years, especially with people now being very over leveraged on the properties, the thing that a lot of people used to sell, which was, hey, this is the cash flow or everything like this. And you see some deals that are paused fully, or they're halved, or whatever they are in distributions, because we don't know where we're going. That is one of the things that most people used to try to sell their investors on. And my thing is that when we're talking with investors, it's really, okay, preserve capital. It's no capital calls, and it's also like the thing after that's most important is really your equity multiple, like really what you're going to come out to at the end of it. And you can compare it. It's difficult because if I compare something to like the S&P, well, that's maybe not the best, I guess, but maybe like to the REITs, you know what I mean? To like an average of REITs, maybe better because you're investing in real estate. But I think one of the things that I have found over the years is that when you're talking to people, it's really, hey, you're diversifying outside of what you're doing. And this gives you a whole nother thing that, yes, as you said before, they are correlated at some point. Stock market goes down, it's kind of thing like this. You're going to have people, and whether it's truly like that, and real estate is a lagging indicator. So we have the stock market goes down, and real estate might not go down for 6-9 months down the road, or might not go down at all, whatever. But the thing though is that when you see this and you're talking to people, it's really the main thing is diversifying, and then also looking at the total business plan. Don't look at the 7% because your index fund is 1.5 giving you off, and this one's going to give you 7 or 8%. The main thing is the diversification in your portfolio. And then the second thing is really look overall what the whole business plan is and what the equity multiple is, because you're buying a business, and people don't see that exactly when they're buying a stock. They're like, oh, I'm buying a stock. Well, no, you're actually buying part of a business, but it's already running and it's already profitable. When we're buying real estate, it's already profitable. But what we're doing is, in this value add situation, is we're kind of disabling that a little bit, right? We're doing work to it and then bringing it back so it's even more profitable down the road. But that means that in the first 12-24 months, that's where it's the most risky. You know what I mean? And you just have to be able to stay through that and know that there's going to be distributions, there's going to be pauses. And then the main thing is that if we're telling you at the end, this is what we're thinking of, you put 100,000, it's going to be, 150, 165, whatever it is on the end. Then that's really what I think the mindset has to be for investors when they're going in and thinking about real estate.
Yeah, no, I really like that, because, think about something is back in the day, if you were getting into business, you would say it would take 3 to 5 years to become profitable, right? I mean, that's not unheard of. People today kind of want that accelerated, right? That 3 to 5 years, they don't accept that as much. But traditionally, it takes 3 to 5 years for your business to become And people don't want that part of it. What they want is when they see the business 10 years down the road, 20 years down the road, and they say, hey, how did you ever start that business? Well, look, in the beginning, it wasn't easy. So people sometimes have a hard time paying the price in the beginning for the reward in the end, but we have to think long range. And if we think long range, we can take a lot of the risk out of life and out of building wealth and financial independence and financial freedom. So I like that you said that because, this isn't get rich quick.
No.
And it's, look, if you can't stay in it for a few years and go and know most things you buy, you're upside down in the first couple of years.
Yeah.
Right? I mean, come on. That's not, you're not going to buy some stock and get lucky. I mean, you can get lucky, but you can't consistently get lucky. That's why Vegas is there, right? I mean, those buildings, they pay for themselves because nobody's consistently lucky. Or very few people are anyway. So talk about what you see coming, because you mentioned something that I think is important, is when, let's say, like Tennessee or Florida, I don't know how many people I talk to that they're coming from California, they're coming from New York, they're coming from these areas where, quite honestly, the price of things don't matter that much. Because in Florida, like in my neighborhood, there are people that have made offers on houses without ever seeing them, cash offers from New York. And it's like, hey, X number of millions of dollars is no big deal. And I want in, I want in there no matter what. And so because of that mentality and people getting out of some of these high tax, high regulation states, and again, this isn't a political statement, it's just that's what's happening is people are migrating out of those states, is I believe that the market is good and it's going to go up. And I'm with you. In 2009, I bought 6 units in 2009 and 10. And then when they doubled, I got out. Well, I can't even tell you how much they'd be worth today. And I think I shot the goose that was laying the golden eggs. I should have just let it ride. And there was no Airbnb or at least I didn't know anything about it back then. I mean, right now, those properties would just be stupid good on Airbnb. So talk about like what you see coming in real estate and how you guys are using the forecasting or the forecast of the future in the next 3 to 5 years to your advantage.
Yeah, that's a great thing. I kind of understand your sentiment exactly, Jim, on that, but it's kind of dangerous thinking. There's this quote by JFK's dad, senior Joseph P. It's like, only a sucker sells at the top. And when you do investing, you think of that and you're like, oh, okay. So if I just have this business plan and I know that when I hit this return is when I sell it, that's when I know. And then you can reassess it at that point too, if you have a clear mind afterwards. But it's very difficult when you're in there and you're trying to let stuff run. But I think what we're doing now is what we've been doing for years, but we're getting less deal flow. A lot of our operating partners that we work with, that we review deals with, is looking at deals, but it's much more we put out letters of intent on properties. Usually they're not coming back within reason. Especially, it still hasn't. We've seen prices go down a little bit, cap rates expand a little bit, but you still have those interest rates that are very high from historically over the last 5 years. You know what I mean? And so with that being said, we just have to be a little bit more conservative with stuff that's coming through. And, these are valuable properties, so we're willing to take a chance on them. And if they're in good areas, that kind of makes up for reducing some of that downside risk. But the thing, though, is that we've seen is that still reviewing deals, we're still buyers. We still have investors that are interested in investing with us on properties that we bring to them. But at this point, over the last 15 months, we've purchased one property, and we've seen one property. And it was we purchased it was in Dallas, and probably purchased it for 10% to 15% less than what it would have sold for, a year and a half before. And even if it goes down lower, it's one thing, I don't, you might think like that and it could happen, but it's also, hey, I got a discount on it from before. And then when we sell it, when we're renovating it, when we're increasing rents, when we're making this property better than it was before, it's all going to work out. And you're going to see even a bigger return on the back end. So it's really like, if you see the deal and it might not be the bottom, you can't really think of where the bottom is. It's really just like, is this a deal? Is this a growing area? Where am I going to be in 5 or 7 years? And I think we make decisions on that end. And over the last few years, we've been keeping properties only around 3 years, but that we've always prepped our investors for the 5 to 7 years. And I think we might hit that with certain properties. And I think you're going to see a lot of operators out there that are found themselves with high leverage on their deals, that they're going to have to kick that can down the road and hold those properties longer too, even if their investors don't like it.
Right. No, I'm with you. All right, Charles. Well, obviously, your family gave you a lot of great advice, and it sounds like you've had some mentors along the way that have given you some great advice. What would you say the greatest advice anybody's ever given you is?
For real estate investing, I would say buy in better areas. They always appreciate better. They're easier to manage. People want to buy those in all parts of the market cycle. Crappy properties, people really only want to buy in good markets, in good times, and good properties, there's always buyers available for those properties.
Great advice. Okay, next question, last question. If you could only retain the knowledge that you've received from one book that you've read in your life, what would it be?
I would say the 80-20 principle. One of the best books. It's an easy read, and you can use it in really all facets of your life, whether it's from your workout to if you're a salesperson to whatever you're doing in your life. And when you think about it, after you close that book and you think about it and you find out that, wow, I'm getting, 20% of what I'm doing is really bringing in 80%. Now, how do I focus in on this 20%? And if people do that, they'll just become a lot more time efficient, and they really know what's really driving the goals that you're achieving.
I learned that as Pareto's law, and the guy that taught it to me said, "Hey, Jim, I'm going to tell you something. It's not 80-20. It's really 90-10." Yeah. And, I love like when Nelson would say, hey, 3% of the people would control. Nelson would say, Nelson Nash, who started Infinite Banking, he would say, if some authoritative power distributed all the money in the world equally among all the people in the world, within 10 years' time, 3% would control 97% of the money, right? And I think it's probably 1% would control 99% of the money. But the question then becomes why? And that 1% or 3%, they understand how to get money to flow to them instead of away from them. Yeah. Right. Yeah. And so when you say the 80-20 principle, I agree, is the people that can spend their time and focus and do that 20% really, really well, they probably can make it 10% of their effort or 10% of their time or whatever it is to get 80% or 90%. So I think that's a great book. I hadn't thought about that book for a while, Charles. So thank you for reminding me of that book. Charles, how do people get a hold of you? How do they reach out? Tell me all your handles and all the different platforms. We'll put them all in the show notes, but tell people the easiest way.
Yeah, so our company is harborsidepartners.com. So if you go to harborsidepartners.com, we have a book on passive investing there. If you're interested in joining our mailing list or becoming an investor, you can fill out and sign up for all that. I have a podcast that you'd be interested in. It's 2 episodes weekly with a YouTube channel, and I'm most active on LinkedIn. And you can just search my name, Charles Carillo. The links are going to be in here too. So follow me. I put out a lot of interesting graphs and all types of tidbits on research, the stuff that I'm reading every week. And I also put that into our weekly newsletter.
Awesome. Well, Charles, thank you so much for being here. And we're going to end this show the way we always do, audience, with the incredible words of Earl Nightingale. So take it away, Earl.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Once again, thank you so much for taking the time to hear what was shared on today's podcast. If you are looking to discover new wealth building strategies, then go to community.createtailwind.com. That's community.createtailwind.com to join our free online community and get access to free courses and in-depth training videos designed to help you build wealth and break away from the herd. Click the link in the show notes to access the community today. Thanks again for listening.